Welcome back to the deep dive, where we really try to get to the bottom of things. And today we are going to be diving into the latest earnings call from carparts.com.
That's right. Ticker symbol PRTS.
Yeah, TRTS. You got it. And I think it'll be interesting because, as always, we've got the press release, we've got the transcript, and we're going to be kind of getting into all the nitty gritty details.
Yeah, and try to, pull out the things that, investors and other interested parties should really be focusing on.
Absolutely. So let's just kind of jump right in and start with, I guess a quick overview of the headline numbers. What really jumped out at you?
Well, I think the first thing that jumps out is, this was a year, and especially a fourth quarter, that was marked by, revenue declines and increased losses. For the fourth quarter of 2024, carparts.com reported a revenue of $133.5 million, which is a 15% decrease year over year.
Oof, yeah, 15%. That's not insignificant. And then how did that look for the full year?
Yeah, and for the full year, the story is pretty similar. Revenue was down 13% year over year, coming in at $588.8 million.
Okay, so revenue definitely took a hit, and I'm assuming that probably impacted some of their profitability numbers as well. What did you see there?
Yeah, absolutely. So looking at gross profit for the fourth quarter, it was down 16% to $43.4 million, and that resulted in a gross margin of 32.5%.
Okay, 32.5%. And what about for the full year?
For the full year, gross profit was down 14% to $196.7 million with a gross margin of 33.4%.
Okay. So, kind of a similar theme there with that gross profit coming down a bit.
Yeah.
And of course, we always have to look at those bottom line numbers. What was the situation with their net income, or I guess net loss in this case?
Yeah, unfortunately, it was a net loss, and it widened quite a bit in the fourth quarter to $15.4 million compared to a loss of $6.1 million in the same period last year.
Yeah, so more than doubled that loss.
Yeah, and for the full year, the net loss came in at $40.6 million, which was a pretty significant increase from an $8.2 million loss in 2023.
So yeah, not great news there on the bottom line. And I know another metric that we often look at is adjusted EBITDA, which can give us a little bit of a clear picture of their operating profitability. So what did you see there? Yeah,
so adjusted EBITDA actually swung to a loss in the fourth quarter. They reported a loss of $6.8 million compared to a profit of $1 million in the prior year period.
Wow, so a pretty big swing there from positive to negative.
Yeah, and then for the full year, adjusted EBITDA also came in as a loss at $7.1 million compared to a $19.7 million profit the year before.
So definitely a trend there of declining profitability. But, just to touch on a couple of the balance sheet items, I know we always kind of like to look at that as well. What was their cash position looking like at the end of the year?
Yeah, they ended the year with a, still a decent amount of cash, $36.4 million. And importantly, they had no debt on their revolving credit facility, which, gives them a little bit of breathing room.
Yeah. Always good to have that financial flexibility. And how about inventory? Were there any, notable changes there?
Yeah, they actually managed to reduce their inventory pretty substantially. It went down to $90.4 million from $128.9 million at the end of 2023.
Okay, so that could be, a sign that they're being a little bit more efficient with their working capital management.
Yeah, potentially. And I think, another important thing for investors to be aware of is that carparts.com did not actually provide any financial guidance for 2025.
Oh, really? Why is that?
Yeah, they cited their ongoing evaluation of strategic alternatives as the reason.
Yeah.
So there's a bit of uncertainty there about, what the future holds.
Okay, yeah, so definitely something for investors to kind of keep an eye on. But I think we've got a pretty good picture now of the overall financial performance. But I think what's even more interesting is to really dig into, the why behind the numbers. So what were some of the factors that the company cited as driving those revenue declines?
Yeah, so they pointed to a couple of key things. First, they talked about price compression, which basically means they were having to lower their selling prices probably to stay competitive in the market.
Yeah, I mean, that makes sense. We've seen that in a lot of different industries lately.
Yeah. And then the other thing they mentioned was softer consumer demand, particularly among lower income consumers. And you can imagine, in the current economic climate, people may be putting off those, non-essential car repairs.
Yeah, if you're having to stretch your budget further, those car repairs are probably something that you can maybe delay a little bit. So that definitely makes sense. Were there any areas of the business in particular that were more impacted by these trends?
Yeah, they specifically called out their lighting and mirrors business as facing some pretty stiff competition from low-cost imports.
Hmm.
And, a lot of those imports, they may not be held to the same kind of regulatory standards, so it can be tough for domestic companies to compete on price.
Yeah, that's always a challenge when you have, those kinds of imports coming in. But, it's interesting because, even with that, lower revenue than expected for the full year, their gross profit and gross profit margin were actually near the upper end of their guidance.
Yeah, that's right. And it seems a little bit counterintuitive at first,
Yeah.
but it suggests that, despite the lower sales, they were able to manage costs effectively in certain areas and maybe optimize pricing on some specific product lines.
Yeah. So, even though the top line wasn't quite where they wanted it to be, they were still able to kind of maintain some decent profitability at the gross level.
Yeah. But I think it's important to note that, the overall decrease in gross margin was primarily driven by higher outbound transportation costs. So basically, it was costing them more to ship those parts to customers.
Yeah, and shipping costs have been all over the place lately, so that's not too surprising. And then of course, we talked about that big increase in their net loss and the decrease in adjusted EBITDA. What were the main culprits there?
Well, it really boils down to that lower gross profit.
Yeah.
Less revenue coming in and then margins being squeezed by those higher shipping costs. So there was just less profit to cover their operating expenses.
Yeah, so it's kind of like a ripple effect. It starts at the top and then works its way down.
Exactly. And they also mentioned increased competition in performance marketing. So basically, they're having to spend more to acquire customers through online advertising and other channels.
So it sounds like those customer acquisition costs are rising. Now, I also noticed that they mentioned some elevated non-recurring expenses for 2024. What were those all about?
Yeah, so those came in at $6.4 million and is mostly related to their ongoing digital transformation. So, they're kind of in the process of switching over to new systems, and that can lead to some overlapping costs, like paying for 2 different software subscriptions while you're transitioning.
Yeah, I've definitely been there with that kind of thing.
And then they also had some expenses related to the move of their Las Vegas facility. So those are, the kinds of things that are considered temporary and shouldn't really impact their financials going forward.
Okay, good to know. So despite all these challenges, what is management's plan for turning things around? What are they focusing on strategically?
Yeah, so they laid out 3 main priorities. First, they want to refocus on driving growth and improving their net profit margin. Second, they want to accelerate those efficiency initiatives to really try to boost profitability. And then third, they're aiming for sustainable growth, the kind of growth that leads to strong long-term free cash flow.
Okay, so, pretty fundamental business objectives, but, obviously even more important in light of, their recent performance. Now, during the call, they also kind of highlighted what they see as their key achievements over the past couple of years. What were some of the things that they were really proud of?
Yeah, they talked a lot about building out their vertically integrated supply chain. So, they have more control over, sourcing and distribution. And they said that that's helped them achieve a healthy product margin in the mid-50% range.
Okay, so that's significant. Having that control over your supply chain is especially important in today's environment.
Yeah, and they also talked about their nationwide direct-to-consumer fulfillment network, which covers, a huge portion of the U.S. population with 2-day shipping.
So they've really invested in that infrastructure to get those parts to customers quickly.
Yeah, and a big part of that is their new semi-automated facility in Las Vegas, which now handles about 25% of their shipping volume.
Okay, so yeah, definitely a lot of investment there. And what else did they point to?
Well, they also talked about their, proprietary fitment-based catalog. And this is really important in the auto parts business because, you need to make sure that customers can find the exact part that fits their specific vehicle.
Right. You don't want people ordering the wrong part and then having to send it back.
Exactly. And they've got a huge catalog with, over 80,000 private label SKUs and 1.5 million premium branded SKUs.
Wow, that's a lot of parts.
And they also mentioned, being the second largest importer of aftermarket collision parts in the U.S. And most of those parts are actually sourced from Taiwan, which helps them avoid those higher tariffs on goods from China.
Oh, that's interesting. So they're kind of strategically sourcing their products to, mitigate some of those trade headwinds.
Yeah, exactly. And, in addition to all of that, they also talked about optimizing their inventory levels. They've got this re-platformed mobile-first website that gets a ton of traffic, and they've seen impressive growth in their mobile app, which now accounts for over 10% of their e-commerce revenue.
So it seems like they're really focusing on that digital experience, making it easy for customers to find and buy parts online.
Absolutely. And they also, haven't forgotten about those professional mechanics and repair shops.
Right, those B2B customers.
Yeah, exactly. So they highlighted their growing B2B business, which now includes same day and next day last mile delivery in North Florida, and they're seeing higher contribution margins from that segment.
So that B2B side of the business could be a real growth driver for them.
Yeah, potentially. And, they're also exploring other ways to, kind of generate revenue beyond just selling parts. So they talked about things like shipping and product protection fees, affiliate revenue, and even a paid membership program.
Oh, wow. So kind of, expanding their ecosystem a bit.
Exactly. Trying to build out that whole suite of services around the core auto parts business.
Okay, so looking ahead to 2025, what are some of their key priorities? What should we be watching for?
Well, they're definitely going to be focused on expanding their product offerings even further.
Yeah.
And they're also going to be looking for ways to better monetize those website visits and their existing customer base.
Yeah.
Through those fee-based income streams.
Right. So, kind of getting more value out of each customer.
Exactly. And they also plan to scale their B2B offering, by rolling out that last mile delivery to more geographic areas. And of course, growing that mobile app business is still a top priority.
And I imagine they'll also be very focused on, maintaining a strong balance sheet and managing their cash flow carefully.
Absolutely. And especially given the current economic environment.
Now, despite all of the challenges, that we've talked about, management still sounded pretty optimistic of the future. What was their overall tone?
Yeah, they expressed confidence that, all of those investments they made and those strategic initiatives they put in place throughout 2024 have really set them up for long-term sustainable profitability. So they're basically saying that they believe the hard work is done and now they're ready to reap the rewards.
So a bit of a, kind of a show me story at this point.
Yeah, exactly. Investors will be looking for those results to start materializing.
Now, of course, we can't forget about that elephant in the room, the fact that they're evaluating strategic alternatives. Did they share any more details about that process?
Unfortunately not. They were pretty tight-lipped about it. They basically said they weren't going to comment or answer any questions beyond what they had already disclosed in their initial announcement.
Okay, so, that just adds another layer of uncertainty for investors. But let's kind of zoom out a bit and put this all into a broader context. What does this earnings call really tell us about the challenges and opportunities for a company like CarParts.com right now?
Well, I think it highlights just how tough the current environment is for retailers, especially those that cater to more budget-conscious consumers. When people are having to tighten their belts, those discretionary purchases like car repairs are often the first to go.
Yeah. And then, specifically in the online auto parts market, what are some of the key takeaways there?
Well, competition is fierce, and there's constant pressure on pricing. And then you have that ongoing challenge of competing with low-cost imports, which, as we discussed, may not always meet the same quality or regulatory standards. So it's a tough landscape to navigate.
Yeah, they've got their work cut out for them. But, they're also making these significant investments in their infrastructure and new business areas. So how should investors be thinking about those investments in light of these results?
Well, those investments in their supply chain, their technology platform, and those new business lines like B2B and fee-based revenue, those are clearly strategic moves aimed at diversifying their revenue streams, improving their margins, and building that long-term customer value. But, as we've seen, the results haven't quite caught up with those investments yet.
So it's really about, kind of waiting to see if those investments pay off.
Exactly. And investors will be looking for those, those signs of progress in the coming quarters.
Now, I also thought it was interesting that they're putting more emphasis on non-paid marketing and growing your mobile app. What's the thinking behind that?
Yeah, I think it's a smart move. They're trying to reduce their reliance on that expensive paid advertising and instead build more direct relationships with customers through their app and other channels.
Right. So, kind of building that brand loyalty and getting people to come directly to them rather than having to go out and find them through advertising.
Exactly. And then, of course, we have that whole strategic alternative situation, which just adds a whole other level of intrigue to the story.
Yeah, it's really a wild card. We don't know what the outcome of that process will be, but it could have a significant impact on the company's future.
Absolutely. So investors will definitely be watching that closely.
Okay, well, I think we've covered a lot of ground here, but before we wrap up, I always like to get your outrageous but plausible trade idea based on what we've learned. So what are you thinking today?
Okay, so how CarParts.com is facing all that pressure from those low-cost imported lighting and mirror parts? Well, what if we take a long position in a company that specializes in aftermarket auto parts certification and compliance testing?
Oh, interesting. So you're not betting on the companies that are selling the parts, you're betting on the companies that are making sure those parts are safe and legal.
Exactly,
Hmm.
because if there's a crackdown on those non-compliant imports, maybe from regulators or even just from consumers becoming more aware of the issue, well, then demand for those testing services could skyrocket.
Okay. Yeah, that's an interesting angle. And I always like how you kind of, think outside the box a little bit. Do you have another one for us?
I do. So, they were talking about how profitable their B2B business is, especially with that last mile delivery. Yeah. So, my second idea is to look at a small cap logistics company that focuses on providing those really fast same day delivery services, specifically to auto repair shops.
Okay, so you're thinking that if carparts.com is seeing success with this model, maybe there's an opportunity for a smaller player to kind of carve out a niche.
Yeah. And, if that trend of faster, more localized parts delivery really takes off, that smaller company could become a really attractive acquisition target for a larger player like carparts.com.
So another, kind of under the radar play there. I like it. Well, I think that's a good place to wrap up our deep dive on carparts.com. So just to recap, we saw a quarter and a year marked by revenue declines, margin pressure, but also a company that's investing heavily in key areas like their supply chain technology and new business lines.
Right. And, that ongoing strategic review process just adds another layer of complexity and the potential upside for investors.
Exactly. So, a lot to watch here for sure. But remember, this is just our take on the earnings call, and it's not financial advice. So please do your own research before making any investment decisions.
Absolutely. And we'd love to hear your thoughts on this one. What stood out to you? What are your predictions for carparts.com going forward?
Yeah, let us know in the comments. And as always, thanks for joining us on the deep dive.